Hi, thanks for joining me. This is Zoe Arthurs from Business Basics. I thought today we would have a look at some financial performance measuring techniques and that we would start with something nice and simple, which is break even. There's a couple of terms that we'll be using throughout the video, so please try and get acquainted with these. They are your fixed costs. Now, it's really important to identify what your fixed costs are in terms of your business. Fixed costs stay exactly the same. They are relative to the running of your business. So if it's fixed, it means it must stay within your organisation. If you were to take it away, then it will not be able to function. Okay, so your business could collapse. So a good example of your fixed costs could be your rent on your premises. It could be your mortgage rates, your council tax, your electricity, some machinery costs. Perhaps it could be anything that's related to perhaps an e-commerce site. So it could be your hosting, your web hosting. So if you took that away, your e-commerce site would collapse. Now, your variable costs are almost always linked to your production costs. So if you're making something, then they are always going to be linked to that. Your total costs are calculated by adding your fixed and your variable costs together, and your total costs will give you a really good idea of how much it's costing you to operate as a business. Now, one other key point that I need to make you aware of is revenue. People often get revenue and profit confused. It's really important to identify that actually revenue is the money that you're making through the selling of your products or services. It is not profit, okay? At that stage, it's just the money you have made by selling your products or services. So let's get started. So you're in this topic. We're going to hopefully cover the following things. So we're going to analyse financial performance and what it means to you and your business. We're going to have a look at how you construct and interpret a break-even chart, how to calculate and illustrate a break-even chart, what the value of this chart is, or if it's worth anything at all, and how the use of data for financial decision making and planning can help you with your all-important business plans if you're at the startup stage. So first of all, it's really important for us to identify actually what is break even. It's a word that's banded around business, but actually what is it and what does it mean to you? So break even is the point at which your business is not making a profit or a loss. Okay, so it's at the point where you're about to move into the realms of profitability, but at this stage you are not. Okay, so it's at the point where your total revenue, so the total amount of sales that you have made, so the money you've got coming in, is equal to your total costs. And this is illustrated by your TR on the PowerPoint, which is total revenue, and your total costs, which is TC. So it's at the point that they are equal to each other. So break-even output is the number of items that your business must sell, even if it's a service, to reach this point. So it has a huge amount of merit for you to identify how many goods or services you have to sell in order to reach that all-important break-even point where you have covered your bills but you are yet to move into profitability. It's a great tool for using in terms of business planning. And if you are going to a bank manager where you are asking for a loan or in angel investors, at this point, you will be able to show them in a visual format how many items you predict, and it is only a prediction and a forecast, you will need to make or sell to break even. So there are two ways of calculating break even. One is through the total contribution method, the other is providing a visual chart, and hopefully I'm going to be able to show you both. So I think what the most important thing is to identify what the word contribution means. Well, we know that contribution means to give towards something. So in business, each time a product is sold or a service is provided, whatever that may be, the money generated has to contribute towards something before you reach that all-important possibility, and I use the word possibility, of you creaming off the profits. So before we're able to take profit off the top of your contribution, it first of all has to pay for its own variable costs. So this is where in business it's really important that you get your pricing points right. So is your selling price going to leave you enough to cover your variable costs, your costs of production if you are making a product, and contribute towards your fixed costs. So your fixed costs are your bills and what your business needs to run. So it's important to know, until there are enough contributions to cover all of your fixed costs and your variable costs, you cannot start to make a profit. So each time an item is sold, the difference between the selling price, so the price that you plan to sell your item for, and remember, don't undervalue yourself, and the variable cost, the cost it's costing you to make the product, is contributed towards your fixed costs. Okay, so your costs that your business must incur in order to run. The business has to keep putting this excess, so the additional money, the contribution that you're making, towards your fixed costs until they are all paid off, before you can even consider to move into the realms of profitability. So your contribution per unit is the difference between your selling price per unit and your variable cost per unit. So in this example, it's how much is left to contribute to your costs. So if I provide you with a very basic example below, you will be able to see the formula that's used to work out your contribution per unit method. So we do this by your contribution is equal to your selling price, so the price you plan to sell your product at, and minus your variable cost, the cost it's costing you to make your product. So let's use this very crude example. If I sell t-shirts at £11.50 and each one costs me £4 to make, then from each of my items sold, I have a contribution of £7.50 to put towards my fixed costs. So SP is my selling price, again £11.50, and I'm taking that away from my VC, which is my variable costs of £4, to give me £7.50, which will be relative to the costs that are the contribution per unit that I'm putting towards my costs. Now, in a business, it's important not only to be able to look at your individual items, but also in its totality. So in the example below this, I've provided you with a formula for total contribution. So your total contribution is the difference between your total sales revenue, remember, okay, so we're talking about revenue here, and total variable costs. So if I sell 100 t-shirts and my total sales revenue is 100 t-shirts multiplied by my selling cost of £11.50, my total revenue for that will be £1,150. My variable costs, so remember my costs to make each of those t-shirts, I'm still making 100, so I then need to multiply that by £4. As we said, that's how much these t-shirts are going to cost to make, and that will give me my total variable costs of £400. Now the formula stays exactly the same, so I have to minus one from the other. So therefore my total contribution is £1,150 minus my £400, which will give me £750 as my total contribution towards my costs. So contributions per units can be used to calculate break-even. As I said, they can be used as an illustrative document, and I would recommend that if you are in the business planning stages, that actually you use both methods, because it will just double check any calculations you've made. So write down the following formula. Your contribution equals selling price minus your variable costs. But in order to calculate that all-important break-even point, where you're just about to, fingers crossed, move into profitability, you first of all have to find that all-important break-even point. And we do that by working out what our fixed costs are. So we know that fixed costs are going to stay the same. We know that they don't change, and no matter how many items we produce, we are still going to be paying the same rent on those buildings. So your fixed cost, which is often a figure, sometimes if you are a bricks and mortar business, into the thousands, we'll be dividing it by a very small number, which is your contribution, which we've previously just shown you how to calculate on the previous slide. And both of those together will equal your break-even point. So the fixed costs to manufacture the t-shirts are £15,000 in this crude example. Your contribution, we know, we've just calculated it, is your selling price of £11.50 minus your variable costs, your cost of production of £4, which gives you your contribution of £7.50. So you can see where I say your big number divided by your little number here will give you your break-even point. So your fixed costs divided by your contribution will give you your break-even point. So your £15,000 divided by your £7.50, so your contribution per unit, will tell you that for this business to break even, you will have to produce 2,000 t-shirts. So have a go yourself. Here's an example for you. Read through the questions and try and work out the following 3 questions. What is the contribution per unit? What is the total contribution? And what is the break-even level of output? Pause the video and come back to me when you're ready. So here is where your break-even chart will start. So it will often start in table format. Now this is a very, very simple format, and it's important to note that break-even will only really be useful if you have one product line. Otherwise you're going to end up with multiple break-even charts, which is also fine, but it is only good at identifying one product line at a time. So you can see from the table, we have the number of t-shirts across the top. So we have 0 to start with. We're just starting out at this point. We have no orders. We haven't done a social media campaign. So at that point, we still have to pay for premises, which are our fixed costs, but actually we've not sold any. So at that point, t-shirts are 0. As we move in and time goes on, we have then, in this crude example, provided you with 1,000, 2,000 and 3,000 because we expect, in the perfect business world, that our orders will increase as time goes on. So you can see by our fixed costs, they remain the same. So regardless of whether I make any t-shirts, so 0 in the first month, or whether I make 3,000 t-shirts, my fixed costs remain the same. Okay, my rent on my building does not increase, my council tax does not increase, so therefore those things which are attributed to fixed costs stay the same. Now what this also shows you is that your variable costs, and remember these are linked to your production, so these are production costs. So as your number of t-shirts increase, so you're having to increase and buy more in, your variable costs and your production costs will increase. So again, you can see, although I've not made any t-shirts, I've got no variable costs in month 1. Let's call it month 1. But in month 2, you can see that I've got variable costs of 4,000, month 3, 8,000, and month 4, 12,000. Now, earlier on in the PowerPoint, I showed you how to calculate your total costs. That's your fixed costs plus your variable costs, and that will give you your total costs line. Okay. Now remember, your revenue comes from your selling price. So at this stage, month 1, we haven't made any revenue. We've not sold any. As I said, we've not had a social media campaign. So our total revenue sits at 0. And that means that in that first month, illustrated by the red brackets, okay, so quite often on a break-even chart or a cash flow, a negative number is often illustrated in brackets, means that we are actually in loss as a business of £15,000. Now that's not unusual. But as we start to make sales and we start to sell these sales and we generate revenue, you can see that we can deduct our total revenue from our total costs to give us our overall profit figure. Now you can also see in month 2, again, not unusual, that we're still working at a loss period. Okay, so we're still in red brackets, we're still £7,500 down and in the red, if you like. But as we move into month 3, we can see that actually the business is now at break even. We've covered our total costs with our total revenue, and at month 3, we are at break even before we move into the realms of profitability in month 4. Now, this is where I recommend you pause and stop. So what I would like you to do is to have a look at your financial projections. Think about how many items would you like to be able to sell, make in terms of revenue, what you think from your research your fixed and variable costs will be, and it's really key to get your research done at this point, and start to put in some arbitrary figures into a table like this. Because even if these figures are incorrect at this stage, it's not important, it's just a practice. We'll pick up in the next video how to create a break-even chart, and that will help move you forward with your break-even analysis. Thanks for watching. Bye for now.